The market is in chaos. Major indices have dropped fast, investor sentiment is shaky, and the headlines are screaming bear market. But here's the thing. This kind of fear often creates massive opportunity. In this video, we're revealing 5 of the best stocks to buy right now in the April 2025 crash. Stocks that aren't just surviving, but set up to thrive over the next 5 to 10 years. I'm Robert, and this is The Alternative Investor. Let's get into it. Welcome back to The Alternative Investor, where we cut through the noise and give you real-world investing insight to help you grow wealth in any market. Be sure to like this video and subscribe to the channel for more deep dives into stock picks, market updates, and strategies for long-term success. And if you're new to investing or want a bonus stock, use the Robinhood link in the description below and claim your free share. The recent market downturn, hitting full speed in early April, is sending shockwaves across portfolios. On April 3, 2025, the S&P 500 dropped nearly 5% in a single day, its worst day in years. The Dow Jones Industrial Average fell over 1,600 points, while the Nasdaq dropped 6%, nearly touching bear market territory. Much of this crash was fueled by President Trump's announcement of sweeping new tariffs, part of a package his administration is calling the Liberation Day trade realignment. The new tariffs include a baseline 10% rate on most imports, and elevated rates for U.S. deficit-heavy partners, with 25% on South Korean imports, 24% on Japanese goods, and 20% on European Union products. President Trump told the press, "This will bring jobs home and restore American strength. The markets will boom, the country will boom." However, markets clearly haven't agreed, at least not yet. Analysts warn that for every 5% increase in tariffs, S&P 500 earnings could drop 1 to 2%, especially in sectors heavily exposed to global supply chains. In a volatile market, it's tempting to chase rebounds or panic sell, but smart investors lean on clear criteria to identify resilient stocks. Here's what we looked for. We prioritized companies with essential products or services, things people need even during economic slowdowns. These businesses are more likely to weather demand shocks. Next, we looked at financial health. Strong balance sheets, positive cash flow, and manageable debt are critical when rates are high and credit tightens. We also focused on companies with a durable competitive advantage, whether through brand dominance, patented products, or irreplaceable roles in supply chains. Finally, we gave extra weight to companies that pay and grow dividends, which signals long-term confidence and helps investors get paid while they wait for recovery. Let's break down the top 5 stocks that fit these criteria, and why they deserve a spot on your watch list right now. Lamb Weston is a global leader in frozen potato products, supplying restaurants, fast food chains, and grocery stores across the world. When markets panic, people still eat fries, and Lamb Weston's sales reflect that. While the broader market was crashing on April 3rd, LW shares actually jumped 10% after the company reaffirmed its revenue guidance and delivered strong earnings. That's a big signal of investor trust in a tough environment. Financially, Lamb Weston posted 15% revenue growth year over year, and their profit margins remain solid, around 12%, showing pricing power and operational efficiency. Looking ahead, Lamb Weston's global scale, essential food business, and continued expansion into new markets make it a strong long-term hold, even in rocky times. Procter Gamble is the definition of a defensive stock. From Tide and Pampers to Gillette and Oral-B, P&G makes the kinds of products people buy no matter what's going on in the economy. During the April 3rd sell-off, P&G actually gained 1.7%, proving its status as a flight-to-safety stock. P&G has one of the cleanest balance sheets in the consumer sector. It sports a low debt-to-equity ratio, and continues to increase its dividend, currently offering about 2.5% yield. With proven pricing power, global brand loyalty, and a history of resilience through multiple downturns, P&G is a foundational blue-chip stock for uncertain times. Johnson & Johnson is a healthcare behemoth, operating across pharmaceuticals, medical devices, and consumer products. That diversification gives it a unique buffer during periods of economic instability. J&J is relatively immune to the current tariff drama since most of its products are considered essential and benefit from stable demand. It's also consistently ranked as one of the most trusted and dividend-reliable companies on Wall Street. The company has an AAA credit rating, huge free cash flow, and just raised its dividend again, marking over 60 years of consecutive dividend growth. Between demographic trends like aging populations and a robust product pipeline, J&J is a reliable growth and income play in a very shaky market. Texas Instruments is best known for its analog chips, which power everything from industrial sensors and factory automation to vehicles and smart devices. Unlike high-flying AI chip makers, TXN thrives in stable, recurring applications. While the tech sector has taken a hit, Citi analysts recently noted that Texas Instruments could outperform other chip stocks in a downturn, thanks to its diverse customer base and capital-light model. TXN has strong margins, minimal debt, and a robust dividend that has grown steadily for 2 decades. It's also trading at a more reasonable multiple compared to AI-driven hype stocks. If you want semiconductor exposure with less volatility, TXN could be your defensive anchor. Corteva is an agricultural science company specializing in seed genetics and crop protection products. With global food supply chains under pressure and increasing attention on sustainability, Corteva is in a growth sweet spot. As inflation bites and trade disruptions continue, food security becomes more important, and Corteva stands to benefit from global demand for higher yields and resilient crops. Financially, Corteva is strong. It has over $2 billion in free cash flow, low debt, and just raised its dividend 7%, showing confidence in continued performance. Between secular tailwinds in agriculture and a business that thrives regardless of economic mood, Corteva is a future-forward pick in a sector built for longevity. Markets are emotional, headlines are dramatic. But if you zoom out and focus on fundamentals, volatility often gives long-term investors the chance to buy great companies at great prices. Whether you're all in on buying the dip or just watching for the right setup, these 5 companies give you a strong starting point for building resilience into your portfolio. Let me know in the comments. Which of these stocks are on your radar? Are you buying or waiting? Don't forget to like the video, subscribe to The Alternative Investor, and turn on notifications so you never miss an upload. And remember, grab your free stock with Robinhood using the link in the description below. I'm Robert, and this has been The Alternative Investor. See you in the next one.